Hey guys, thanks for joining us for another edition of Planning Priorities. I'm Jarrett McKenzie, Senior Associate at Henssler Financial. Let's face it, the year 2020 hasn't exactly been one for the memory books. Sure, there's been a few highlights here and there, but it's been a challenging year to say the least. Fortunately, challenging times often create some of the best opportunities. An example of this is the interest rate environment we find ourselves in today. As most of you know, interest rates are the percentage at which a lender charges you to borrow money. And while these rates may vary between borrowers, due to things like our credit score, payment history, they're almost always driven by one very important factor, and that's the federal funds rate. Simply put, the federal funds rate is one of the ways in which our Federal Reserve controls the money supply within the U.S. economy and is an important benchmark for many of our country's lending institutions. As a result, this rate can have a significant impact on many areas of the U.S. economy. But since mortgage rates are closely tied to the federal funds rate, they too are at historically low levels, which has brought about some unprecedented opportunities within today's mortgage market. For example, for the first time in our country's history, the rate on a 30-year fixed-rate mortgage recently fell to less than 3%. Obviously, this is allowing borrowers to afford much more home than they've been able to in the past. And what's more is that home prices haven't suffered like they normally do during economic downturns. Because of the historically low interest rates, demand for homes in many areas of the country has continued to rise, which has caused a similar increase in their value. This, in turn, has been the catalyst for an even greater opportunity, which is a cash-out refinance. For those of you who purchased a home prior to 2020, it's likely that you have a considerable amount of equity in your home, and even more likely that the interest rate on your loan is higher than what is available today. As a result, completing a cash-out refinance on your home could allow you to access that equity while locking in these historically low rates before the mortgage market starts to reverse its course. Even if you're approaching retirement, refinancing can be a viable option, especially if you have plenty of equity in your home and you intend to stay in that home throughout retirement. With the after-tax proceeds from the refinance, you could plan for your liquidity by laddering out fixed income for the next 10 years, covering the mortgage, property taxes, and living expenses, thus delaying how soon you may need to tap your tax-deferred investments. A retiree could have 10 years of mortgage payments set aside, mostly protected from any economic change that may or may not happen. And while this situation may not work for every investor, it's worth considering at today's low rates. Your cash flow may benefit from carrying a mortgage in retirement. But above all else, this strategy makes sense because the equity in your home is only as good as your ability to access it. Keep in mind, you may not be able to pay the taxes, keep the lights on, or pay for food if your cash is tied up in your home. And unless you're planning to sell your home, then refinancing your mortgage and cashing out that equity in the process is one of the few alternatives you have of gaining that access and using those proceeds to improve the financial aspect of your life. Ultimately, this is one of the best opportunities we will ever have to do so, because if there's one thing we know for sure, it's that interest rates certainly won't remain this low forever. So if you have questions regarding how refinancing your mortgage can work for your situation, the experts here at Henssler Financial will be happy to assist you. Thanks again for watching this edition of Planning Priorities. I'm Jarrett McKenzie.